Alright, Assalamualaikum and greeting to all of you. My name is Muhammad Aidil bin AMIDUDIAN. My matrix number is 289,499. I'm going to present to you guys about the financial statement analysis due to the impact of COVID-19 on firm financial performance about company Netx Holdings Berhad. What ratio is being used? I'm using the three ratio. For the first one is gross profit under profitability matrix, and then the second one is the current ratio under liquidity matrix, and the third one is the debt ratio under solvency matrix. Okay, I'm going to start with the gross profit margins. Between the gross profit margin of 32.19% in 2022 and 11.48% in 2021, the higher gross profit margin is considered better. Gross profit margin measures the percentage of revenue that remains after deducting the cost of goods sold. A higher gross profit margin indicates that the company is generating more net profit compared to the revenue generated. This can suggest efficiency in cost management or an improvement in pricing or margin profitability. Therefore, with a gross price profit margin of 32.19% in 22 and 11.48% in 21, the higher gross profit margin is in 2022 is considered better than in 2021. However, it is important to consider other factors such as industry trends, competition, and other aspects in the overall assessment of the company financial performance. Right now, I'm going to talk about the current ratio, the second current ratio. For the first one, both the current ratio of 7.94 in 2020 and 12.21 in 2021 indicates good liquidity. The current ratio normally measures the company ability to cover its short-term obligation using its current asset. Also, a current ratio above 1 is generally considered favorable, as it indicates that a company has more current asset than current liability, suggesting sufficient liquidity to meet short-term obligation. However, the ideal current ratio can vary depending on the industry and specific circumstances. Other than that, by comparing the two ratio, we know that a higher current ratio indicates a stronger liquidity position. Therefore, the current ratio of 12.21 in 2021 is relatively higher than and suggests a better ability to cover short-term obligation compared to the current ratio of 7.94 in 2022. Why this happened? As you can see in the slide, in 2021, the current asset is more higher than 2022, which is from 112 million decrease into 93 million in 2022, and it shows that the company reduced its current asset, and it really affects the current ratio itself, and it might be the effect of the COVID-19 to the current ratio of this company. Hi, I'm going to explain about to you guys the third ratio, which is the debt ratio. For the first one, when we evaluating the debt ratio, a lower value is generally considered better. The debt ratio normally measure the proportion of a company asset that are financed by the debt. A lower debt ratio indicates that a smaller portion of the company asset is funded through debt, which suggests lower financial risk and greater financial stability. Also, by comparing the debt ratio of 0.25 in 2022 and 0.23 in 2021, the debt ratio of 0.23 in 2021 is lower and therefore consider better. It implies that a smaller percentage of the company assets were funded by the debt in 2021 compared to 2022. However, we know that the company tried to generate more money by getting the debt to improve its company, and this is why the ratio in 2021 is much better than 2022. However, it is important to know that 2021 is the year of the COVID-19, and meanwhile for the 2022 is the year that we try to recover from the COVID-19. Last but not least, for the debt ratio, we need to know that what is considered a good debt ratio can vary depending on the industry, company size, and specific circumstances. It is advisable to compare the debt ratio with industry benchmark and evaluate it in conjunction with other financial metrics and factors to gain a comprehensive understanding of the company financial position and risk profile. Alright, for the conclusion, overall, considering the gross profit margin, current ratio, and debt ratio, 2022 performed better in terms of profitability, while 2021 performed better in terms of liquidity and financial risk. The choice of which year is more favorable depend on the specific financial goals and priorities of the company or the individual making the assessment. Also, by do the financial analysis, we can see that in 2021, it shows that the COVID-19 give impact to this company, which is Netx Holding Berhad. That's all for me. I hope you guys understand what I'm present to you. Thank you very much.